Okay, let's kind of conclude our discussion of ratio analysis by talking about some of the challenges with some of the ratios and things we've been talking about. So let's spend some time with this return on equity. And they refer to something referred to as the timing problem. I think this timing problem is universal when you think of financial ratios, right? Financial ratios are based on historical data. So by definition, historical ratios are not forward looking, right? Do they have does especially return on equity, does it have a long-term perspective? Well, it does in the sense that shareholder equity is long-term, but the numerator, net income, by definition, is short-term. So there is a bit of a timing issue, but this is a timing issue with all ratios that they reflect historical performance, not future performance. So how does ROE reflect risk? Well, it doesn't really take into account business risk. So we want to kind of understand, what about investing in capital, right? So there is a measure, right? It's called return on invested capital. Sometimes it's ROIC, sometimes we refer to ROI, but it is a measure of return on capital independent of the amount of leverage. So you take EBIT times 1 minus the tax rate. So this is the operating profit after taxes. And you divide it by the interest-bearing debt plus equity. So again, the greater this number, the greater the return on the invested dollars. These are dollars that have been invested by the outside world, right? Shareholders and creditors. So the higher the number, the greater the investment or the return on invested dollars is. What about a value question, right? So should these calculations be made on book equity or market equity? So we have two ratios that they represent here. One's called earnings yield. One way to calculate that is earnings per share divided by price per share. Again, this just tells us the earnings based on shareholder investing, right? It can be done in dollar terms or in per share terms. I'm not quite as familiar with what that ratio means, but on the other hand, we have another ratio that's the reciprocal of that. It's just the price divided by earnings share. It's called the price to earnings ratio. So the earnings yield for Hasbro is 5.6%, and it's 17.9 is the PE ratio. Well, again, I like the PE ratio. So what does that tell us? The PE ratio basically tells us three things. Number one, it is a picture, if you will, of the optimism of investors. The higher the PE ratio, the more optimistic shareholders are about the future. How do we know this? It gets bigger as the price per share goes up. People don't drive up the price if they think the future is worse than today. The second thing that the PE ratio tells us is it gives us a little bit of a clue of a payoff, right? On average, how many years does it take to get your money back from an investment? You spend $77, right, on the asset, and at least this year it paid you $4.34. So if you got $4.34 back every year, it would roughly take 17.9 times to get your money back. The third thing that it shows us, and these things are all kind of intertwined, I guess, but basically it says, how much money are investors willing to pay to get $1 earnings from this company? In this case, they're willing to pay $17.90 for every $1 in earnings. So the higher the number, the greater the optimism is of the investors. Now, one of the questions we have about this is, what about the price, right? Are there any problems with using price in these ratios? And of course, there aren't, right? The price changes frequently, right? So what is best to use, right? So, how do operating decisions affect the stock price? Of course, they're going to make it move, right? Managers should know more about a company than outside investors, right? So stock price depends on many factors that are outside management's control. So the stock price is a variable that by its very nature is uncertainty and has so many different variables that affect it. Using that in a ratio can create some problems. But again, if we're doing this for all companies and all industries, hopefully those problems are reflected in all companies and industries. So our final discussion here is a little bit more about ratio analysis, right? So things to keep in mind, right? Ratios don't tell the whole story. In fact, I like to think of ratios as kind of like going to the doctor's office. You go to the doctor with some symptoms, right? Those are ratios. Either the symptoms are good or bad, right? The doctor's job is to tell you what to do with those symptoms, right? How to keep yourself healthy or how to get yourself healthy. There are no universally correct values for ratios, right? Is a number good or bad is dependent on several things primarily, one of which is the company itself, but also we have to look at the industry. I mean, you would have to assume that all of the soft beverage companies in the soft beverage industry should act pretty much alike, right? If the industry is doing well, those companies should be doing well. So if I can compare myself to my industry, that should tell me where I'm at in the hierarchy of performance within my own industry. In addition, obviously, I can look at historically. Am I getting better or worse? Part of that, though, is that ratios do reflect historical performance, right? They don't necessarily predict anything that's going to happen moving forward. So again, kind of concluding here, right? Ratios, you have to understand the context with which you're seeing the variables. We've talked about making comparisons, right? So everything has to be done relative to something else. We basically have then some questions we can ask. And I think if you have these questions on the side, if we're looking at a company, you want to be able to answer these questions, right? Profitability. What do the measures tell you? Is the company making money or not making money? What does it look like over time? How does it compare to the industry? What about the levers, right? We talked about those three things. How are they affecting return on equity? Are they changing over time? That's obviously going to reflect on the profitability of the company. What about the control ratios? Are we managing assets well, right? Leverage ratios. What's the trend in the industry, right? What's the trend in the company, right? I'll just tell you as an example, a company that I've been following for several years because I've been using it as an example in some of my classes is the Molson Coors company. Now, Molson Coors in general has relatively low debt. However, when they want to buy something, they are not afraid to borrow. So their leverage ratio looks like mountains, right? Because they borrow a ton of money and then very quickly they work to pay that debt off. So that's just, that's looking at the company. It's the way the company has decided to manage the financing, right? So am I concerned? I'm not concerned if they borrow a lot of money because history tells me they pay it off pretty quickly. Next, so let's look at, here's just a real snapshot. We've gone through all of these ratios. These are the ratios for Hasbro over time. And of course, on the right here, we actually have a number for the industry average. There are sources that you can go to find historical industry averages. But again, this is just a nice way of looking how has the company performed. So if you look at return on equity, right, we seem to be in the upper 20s most of the time, especially the last 3 years here, and the industry is at 14. So how would you analyze this? We seem to be increasing in liquidity, at least in the last 3 years, our numbers are up, and we are twice as profitable as what the industry is. And of course, we can go down the list and find all of these numbers and make the same relative kinds of statements about the company's performance. Now, another set of ratios that we can look at that are very helpful are what are referred to as common size financial statements. These are statements that take a financial statement and they divide all of the line items by a certain number. So the common size income statement, everything on that statement is divided by sales. On the balance sheet, everything is divided by total assets. So this gives us a relative picture of how things relate on a statement. What is the average cost of the cost of goods sold of the company? It'd be nice to know that, right? What is if you look at the common size figures, right, they can give us examples, right? Let's look at the collection period. What does that look like over time? What do we know about the working capital of the company, right? You can answer a question about the cost of goods sold. So let's take a look at these. Here's the common size balance sheet. And just to give you a little picture here, we could take what's the average amount of cash? Well, in the last couple of years of the total asset of the company, they've got about 20 to 25% of their money, of their assets, is in cash. That's a huge, huge pile of cash, right? Accounts receivable, likewise. So just in cash and accounts receivable, we have over 50% of the total assets of the company are in those two very short-term items. What about plant and equipment? Plant and equipment, if you look at net, is only 5% of the company. So relatively speaking, especially if you look at plant and equipment, compared to the industry, they have much lower amount of plant and equipment than the industry. We can also do the same thing with the income statement. Here we were looking at cost of goods sold. You can see that annually it's in the ballpark, 45-46% is the average cost of producing products. If you look at total operating expenses, let's go to operating income because that's another profit number. You can see that on average, this profit item is around 15-16%, which is pretty decent over those last couple of years. And it seems to be increasing. Net income, you can also see that over the last 5-6 years here, we've seen a steady increase in net income as a percentage of sales. So again, we've gone through several different slides and ratios, and we've talked about this. It's really fairly complex. but the actual process is very mechanical, right? You get the statements, you do the formulas. The important part then is the analysis, right? And it's not the numbers. What I find typically of students, as far as when you ask them to analyze something, they would say something like this. Well, if you look, cost of goods sold, 46%, 46, 45, 44, 46. Basically, that is their cost of goods sold percentage. Well, that's not really what we want to know. We want to know, is that a good number or a bad number, right? If you were a manager of this company, what are some things you could do to fix this number if it was bad? That's what analysis is all about. This is a skill, right? It's something you get better at the more you do. So anyhow, that's the end of this video. I look forward to seeing you in some future topics. Bye-bye.